So let's tackle the resources segment first. We're actually very bullish the resources at the moment, primarily driven by what's happening in China. We think there's a mini stimulus program going on in China at the moment. There's an inventory rebuild process which is underway now. They've reduced inventories right across the manufacturing apparatus, if you like, in China for 5 years. Stimulus coupled with nothing on the shelves. You've got a mini boom in China at the moment. Not much supplies come online either. All the miners have been in a world of pain over the last 3 or 4 years. And then you only have to have words out of Trump and other parts of the world about potentially reflating the economy. So I think resource price is going to stay pretty strong for the foreseeable future, and the cash flow coming out, particularly the Australian resource companies, BHP, Rio, South 32, huge focus on shareholder returns. Make no mistake, these guys didn't focus on shareholder returns only going back three years ago. Change of board, change of management, cash flow back to shareholders, coupled with what's happening on the global outlook. I think market or investors are still underweight the resource companies. So we like them. We're overweight in our portfolios. Banks is interesting. We had a really large position in the banks in terms of how we were positioning clients and recommending clients to structure their portfolios. We still largely think that's the position, particularly for the Aussie banks. There's some really powerful global themes. We're of the view that capital requirements will be a lot less than what investors previously thought. And particularly the US is going to take a little bit of a more active lead, and their change or proposed changes to lower regulation, I think, has global implications. Locally at home, the banks, unlike many other global or many other countries, our banks in Australia don't suffer from huge amounts of excess competition. There's really 4 players, 85% of the home loan market share, and they're earning huge ROEs on home lending. So we think dividend payout ratios are high but sustainable over the short term. Lower capital or not increased capital requirements to the extent some people think. With the emergence of earnings growth for the first time in 2 years, banks to us still look like a good place to be. Yeah, interesting question, Roy. It's been tricky the last few years. If we look over the longer term, if we go back last 100 years or so, the number one performing market globally across any market in the world on a real return basis after inflation is Australia, and interestingly, it's about the 3rd lowest risk country measured by annualised volatility in total returns. So tricky little past couple of years. We've had resources under some pressure. We've had bank earnings at an EPS level under a little bit of pressure because our banks raised capital, preventative capital for new capital requirements, and that lowered earnings growth per share. So with those 2 issues kind of reversing, and those 2 sectors are circa 65% of the Australian market, those 2 sectors reversing, our outlook for the Australian market is reasonably constructive at the moment. And we've seen in the last reporting season the emergence of earnings growth, clearly in resources, absolutely spectacular level of earnings growth. Banks emerged with earnings growth as well for the first time in 2 years, and more broadly crept into the industrials as well. So we think for the first time after flat to zero, even negative in a couple of large sectors over the last few years, we'll now start to see a better tone to earnings growth, and we think that's pretty supportive for the Australian market. Yeah, so clearly big positive views on banks and resources. Technology we're constructive on. We're also constructive on really a select number of industrials. And once you start getting into the industrials, we're more selective on names rather than themes. The housing theme is probably one which we're still playing, whether it's through a Harvey Norman or a Nick Scali in terms of retailers. Different businesses. One's a mega business in Harvey Norman. One's a more specialised business which is about to launch here in New Zealand. They've had very good periods of growth, and probably over the next 2 years likely to continue to have growth. In technology, there's a number of Australian companies which play really well in the technology space. Technology One is a cracking Australian company, very similar to an Oracle or an SAP, and we think there's good growth ahead there. Healthcare is another area where we really like the outlook. Australia's a little bit more than just resources and banks. Healthcare, we compete very well at globally. So something like CSL could be, can continue to earn good rates of return. We think it's a cracking business, and we've seen recently the market underestimate the amount of earnings that they can produce. ResMed, another name in that space which we really like in terms of the large mega caps. So banks and resources, the big two themes. Outside of that, it's very much company specific themes in terms of what we like in Oz.